Who am I? Oxo Tower. No, it's in the
Here
background.
we are, John. We're live here. Here we are, taking stock live on July the 7th, 2023. And of course, I'm live just in front of a big chart there. And John's live in the city. And
Oh yeah.
listen, John, I want to start off today, right? This now, AIM, it's dreadful at the moment. The markets are dreadful. And AIM right now is at a new low today, 739, right? Now, apart from the dash for cash crash in March 2020, the last time this low was in July 2016. That's pretty much 6 years ago. That shows you where we are right now. And in fact, let's take a quick look at the indices. I'll flash the indices out. Let's go straight to London Stock Exchange here and share my screen. But you need to, James, in the background there. I need to activate my screen there. But the FTSE is down again, a bit more than AIM, which is unusual because normally AIM is the one that is the worst thing, but it's down again, FTSE. But this is the question I want to pose today, John,
Oh,
and it's a bit controversial, but I want to get people involved.
They've lost sound.
Oh, you've lost sound, have you?
No, there you go.
Okay. So this is a bit controversial, okay? Now, people have called AIM, there's a lot of trash on AIM. We know that. There's a lot of good companies on AIM, but there is a lot of rubbish on there, and it drags the market down. Like, so we're down about 43% from the high now. And so this is a topic of the day. Should AIM, because AIM is a place where companies go, startups go to raise capital. They may be pre-revenue, they're loss-making, some of them, and so they have to access that capital. They can't get it from a traditional banks. They haven't got any revenue coming in, so AIM is there for that. But surely the ultimate goal of any business is to start generating profits, their own cash flow, and be self-sustainable. So this is my thought. Shouldn't there be a time limit on new companies coming to AIM, say 5 years, where they have to be profitable in their business plan within 5 years? Otherwise, they're delisted. Because all that happens is you get companies now starting up on AIM. They've been starting up for 10 years, raising money constantly.
I'm struggling with the tech here.
Well, fleecing investors, but fleecing investors for more money. Shouldn't there be literally a time limit, maybe 5 years, where companies, should be profitable? What do you reckon, John? Oh, John's gone. He's going to give his opinion. He's gone. Anyway, listen, if you want to, get involved with that, let me know, and I'll read out some later. All right.
Sorry,
Go on,
I'm having some tech issues. No, I'm going to answer your question, Justin. Sorry, I'm having tech issues here, which is, of course, what happens the first time you go live with something like this. No, I mean, I think the trouble with something like this, I understand exactly what your point is. There are a lot of companies that just seem to come back to shareholders time and time again.
Yeah.
But AIM is a growth market. This is the nature of the beast, and we should never treat AIM like perhaps we treat the FTSE 100. It's not a trackable index because of its very nature, because of the nature of the companies that are within it. If you pick a time limit at which a company has to become profitable, it's arbitrary. It's arbitrary. Why 5 years? Why not 10? Why not 2? We should give companies on AIM, if this is what they have come to AIM and this is in their prospectus and they've said it's going to take us this long to become profitable, then they should be given the chance to do that. And then if they don't meet the promises they've set out to investors on day one, then it is up to the market to decide. The market as a mechanism will decide which companies it wants to support. And if we chuck all companies out, chuck out, every company that doesn't become profitable in 5 years, you potentially chuck out the baby with the bathwater. There are some brilliant companies that have taken a very, very long time to reach profitability, and particularly over in the US. I think we would be. In
fact, I think Twitter would be off anyway, because Twitter's been there for more than 5 years, still loss making. I think so. There are lots of big companies. I understand that, but I'm talking about how do we measure it then? Because there are companies that private investors get obsessed with, and literally they fall in love with, and they just don't believe the figures. They believe the CEO or the hype around it, and then they don't believe the figures. You think this company is not improving. All it's doing is sucking investors' money in, when that money could go to better companies that are looking to develop a bit more.
This is true, but then this is the nature of the market. This is why the market is the way it is. If a company has failed to deliver on its promises time and time again, then investors don't have to give it more money. If a company tries to raise money and investors have lost faith in its ability to keep its promises, to deliver on, the strategy that it sets out, then the market will decide. Yes, it looks horrible at a headline level, but I don't really care about that headline level. It doesn't mean anything. Particularly with the AIM market, which, as I say, is not a trackable index. So, it's the market, it's investors that decide. And I'm all for, rules that make the market a safer place. But I think this one would also encourage some strange behaviour. I mean, what is profitability? How many adjustments will we get?
Yeah, I hate that. Do you know what? I'm looking at broken notes recently, and there's adjusted this, adjusted. What's it adjusted for? Stop adjusting it. I can't figure out if you're making any money or not. It's like it's a wage. I know. Yeah.
I mean, the reality is as well. Is profitability. Whatever form that takes, whether EBITDA, EBIT, pre-tax, post-tax. Is that the measure to be looking at anyway? Because if the problem is coming back to markets to raise cash,
that as well, couldn't they?
That can be manipulated.
The level, yeah.
So actually, should we be looking at, if we were to implement a rule like this, should it be a cash flow measure?
I just think there's a lot of companies out there that have got away on AIM for a long time. They've not really improved. All they do is keep going back to the market and literally keep tapping investors. And I think maybe
that's a bull market. That's a bull market for you. That's the kind of thing that happens. And then what happens in a bear market like we've had is it all comes out in the wash. And you've almost got to think about it as like creative destruction in a way.
It does come out in the wash, doesn't it? It is the old Buffett saying. You see the people with no shorts on when the tide goes out, and we've had a lot of companies actually delist recently. And I suppose that is a natural cleansing mechanism to get these zombie companies out. But anyway, listen, if you think that there should be some kind of time limit or some kind of metric they should fit, because it is a sort of startup access to capital market, a junior market, with a hope maybe going on to the main market, maybe, I don't know, but who knows. Have a subscriber and like on our YouTube channel and add a comment there and we'll pick it up. Let's look at some winners today. Renalytix. Do you know anything about these, John?
Not a great deal. I had a read, and we talked about investing in healthcare this week already, and how it's a very, very exciting sector to be in. But this is one I really struggled to understand. This RNS. It's very, very sciencey.
Well, I went back a little bit because a few days back they had FDA approval, de novo approval, marketing authorization for its Kidney Intel X.dkd.tm. Let's make that a bit more simple, guys. It's a prognostic test of the kidney. This affirms Kidney Intel X, as in first-in-class artificial intelligence. That's the hot little phrase there, isn't it? Enabled prognostic test platform to guide care management for adults with type 2 diabetes and early-stage chronic kidney disease. So it's a prognostic test using AI, so that's very hot. And also they just presented this evidence apparently to the ADA, which is the American Diabetes Association. I guarantee there's a lot of people. There's a lot of people in America. Do you know what? One thing I remember once, I stayed in a house right in London. I say house share, and the girls I shared the house with brought some American sailors back one Saturday evening. They were there Sunday morning, and they saw EastEnders. They said, "What's this?" And we said, "It's a soap opera." I said, "Wow, man, there's real people on this." So he said, "In America, you don't see any normal people on telly. You've got to be models." He said, "If you go around and look at the normal public, you see a lot of obesity there, which is not reflected on the TV." And so I suppose there's a big market. What I'm saying is a big market in the US for diabetes too, I suppose.
Oh, 100%. I mean, it's a killer. I mean, obesity, which is a cause of type 2 diabetes, is a huge problem, not just in America, but the world over, but America particularly. So, if there is a way, diagnostics are a great segment of the healthcare industry to be in. And, if this is successful and it presents clear clinical advantages, then great. It's addressing a market need.
Look at that for a chart. They literally IPO'd in what, 2019, something like that, 2018. Where we are right now, actually, but that's a hope pipe potential chart. It's gone up from, is it 10 bagger pretty much within a couple of years, and then the top of the market, the bull market, pretty much the June top of the bull market, and it's come back down to pretty much IPO level. But if we zoom in right now, a couple of times it's trying to break that 200-day moving average. It's done it there, came back down, and it's done it again with this news a couple of days back, the FDA approval. But yeah, that's a good looking chart there.
Yeah, I mean, a lot. If you look at the timings of it as well, there was a lot of hot money floating around after the pandemic. And companies like this, particularly in the healthcare industry, all benefited from that sort of rising tide of focus on healthcare. So you have seen a lot of that, and it does make these charts look a little bit nasty. But again, this is a classic example of what we were just talking about in respect of AIM. Developing pharmaceutical products, biotechnology products does take a long time. And so if you were to stop these companies being listed and stop them having access to the capital they need, and I don't think there's anything wrong with coming back to investors as time progresses, then companies like this that are developing potentially very innovative solutions won't have access to capital, and then you've got a problem.
Yeah, I suppose so. What about another riser today? Is MGC Pharmaceuticals? I've chatted to them. Have you covered them as well? I think but they're on this sort of the cannabis sort of trail or plant, they say. European-based pharmaceutical company specializing in the production and development of plant-derived medicines. The AMC places another US order for $1 million. Order of Artemic. Are you aware of this company?
I am. Yeah, this is one we were talking about the other day. This is a company that stands to benefit very much from some of the trends in plant-based medicine development. We were talking about Australia and the plans there the change there to reclassify MDMA and psilocybin and for clinical use. And this is what MGC does. But this is a slightly different product. This one, I think, it's something to do with this thing called a cytokine storm, which happens in infections and sort of certainly post-COVID infections. So this is again, it's important stuff. This is it's the body's sort of inflammatory response to illness, and sometimes it just goes wild. And then it becomes deadlier than the disease itself. And Paul Begg's working on stuff to treat cytokine storms, to prevent cytokine storms. This is the same sort of thing, albeit delivered in a slightly different way and with a slightly different purpose. So this is, again, I'm impressed here. This is a real product. It's out in the market and it's shipping. So this is.
Well, do you know what? They've not had a lot of luck. I mean, when they first listed in Feb, again, in the bull market, everything's a lot of easy money flowing around. So people get easy to list there. People are throwing money at you. But since then, look for that downturn. Look at that 200-day moving average. It's not gone near that. Pretty much, the 200 started in November 21, didn't get anywhere near it. It's still not, way below that. So, you want to see that breaking above previous highs at least, and then maybe making a headway towards that. But I don't know, maybe there's a seller in there. I don't know, but
maybe it's a horrible market. It's a horrible market.
Yeah. Another riser. Go on.
No, I just say, it's a company doing good stuff. There is always this concern about cash. And there's always this concern about that, that runway and whether it's enough to take it to break even. So again, coming back to our first question, I want to give this company a chance. So I think, it's fair enough that it has the opportunity to raise some money.
Maybe there should be a committee of people who decide on the delisting. So you've had 5 years. Let's look at the evidence. And then you say, no, I think you should give them a bit more of a chance here. Or is it a bit like X Factor, or Dragon's Den,
Okay, that sounds good. I'm sure prime time television viewing.
Aptima Group is another winner today. It was really up 17%. The developer of novel Optima binders to enable innovation in life sciences. They've got it's tiny, sort of nano cap they are really, but they've won a contract worth $500,000 pretty much over the next 6 months. But if you scroll down, there's this the shadow of finance or lack of finance hanging over them. And they did say at the bottom of that RNS, they're still looking to raise money. They got $200,000. In addition to trading income, further funding will be required. So be aware of that. They're going to need to do that. But it's a horrible market to try and raise in. And recently, they were a massive riser on, I think, Alzheimer's tests. They were in conjunction with another company, but a prognostic test for Alzheimer's early detection. And of course, that's a huge market with a growing aging population. I've been touched by, many people have been touched by Alzheimer's. My mother had it, but that shot about 160% of it in one day. And then people read further down the RNS about funding, and it came back down, I think. But do you know anything about that company at all? I mean, they are a microcap.
Not a great deal, but I mean, it is. It's the kind of company in the healthcare space that I kind of like. And what I like about them is that they're not trying to deliver novel treatments. What they're trying to do is provide the tools with which other companies can develop those treatments. So, here we go. The Optima binder is going to be used with an antibody in a sandwich pair format to advance neuroscience disease research. So this is the building blocks of biotechnology and pharmaceutical. Antibodies, incidentally, are made by a company called Bioventix.
That's
which
right,
has
yeah.
been incredibly successful, massively scalable. It makes these monoclonal sheep antibodies, which are then used in drug research. So I like picks and shovel companies, and this falls into that bracket. But the cash
Did
thing
you
is
say
what
sheep then? Did you say sheep?
sheep monoclonal antibodies. It's the
I
best
thought you said
antibody for
sheep.
this. I did say
Yeah.
sheep.
I don't, did you say sheep? Yeah. Okay.
I did.
I always remember that was a funny thing, wasn't it? When they managed to clone the sheep. And
Oh,
that was the
Dolly.
big,
Oh,
that was the
Dolly.
big
Yeah.
joke. How do you know? They all look the same anyway. You know. It's
I
like,
don't know. I don't
yeah.
know. I'm a country boy now. Sheep all have very different personalities, I'm told.
Now, losers wise, it's very rare you see a big cap falling, over 20% in a day. And this one savings bank, not news at the day, but news yesterday about, of course, it's caught up with all the problems with buy-to-lets and people remortgaging all that. But they've dropped, and it was about. I don't know if you look at that trading update, it says basically that a reduction in the expected time spent on the reversion rate by Precise Mortgages customers is estimated to result in adverse underlying effect of the interest rate adjustment, and so they have to adjust by 160 to 180 million. That's the deal there. And let me just share the screen with you, the chart, because it's not. It's look at that. It's not pretty.
It's a huge number. That's a huge number. When you think about what are the overall profits of this group expected to be?
Well, the market cap is about 1.8, so that's a tenth of that of the overall value. So in 1 year, so yeah. So that's,
so let's have a look. Pre-tax profit forecast for this year is 550 million. So that's a big chunk of that.
Yeah,
that's a big chunk of that. So that sort of relative to the scale of what essentially amounts to a massive profit warning. It's really interesting. And I think
these are like the things you don't see when we have interest rate rises and all this. The knock-on effects of all that was what's happening. And I sort of do believe the theory that the central banks are not. They can't be this stupid, surely. But I don't think they're taking into account the lag effect of what this tightening will have. And I'm talking about the lag effect of next 2 years. I think, and what's going to happen is they're going to have to sort of wind back interest rates and really bring them back down to get the kickstart the economy again. Because I do think it's like that analogy of trying to stop that super tanker heading into the shore when it takes them 2 miles to stop that thing. And literally we are now half a mile from the shore. You're thinking, hang on a sec, whack it in reverse quickly. We're going to take out Dover or something unless we do that,
I think this is really interesting. And actually, there is a big question, not just for OSB, but for the industry as a whole. So what this specifically means is that a customer who's on, say, a 2-year fix or a 5-year fix, at a fixed percentage rate on their mortgage, when that point comes, when they come off that rate, they'll go to the standard variable or what it might be. They'll revert to that rate. And I did not know that banks made assumptions that customers would sit on that higher rate for a certain amount of time.
Yeah.
And what's happened here is that actually what customers are doing is saying, we're not going to sit on that higher rate. We're going to refinance as quickly as possible. So that those profits the bank would have made from a customer sitting on a higher rate from inertia are not going to happen because customers are switching very quickly onto a new product.
And I suppose that's a result of it being everywhere in the news. You can't avoid this news. I mean, the interest rate hikes have been everywhere, so it's not as if you see someone who's got a buy-to-let or mortgage that would be unaware of what's happening, so let's switch as fast as we can,
Exactly. And it goes back to, what we were talking about the other day, that, actually, an OSB is a big lender to the buy-to-let sector. It was what we were talking about. These customers are in the worst position when it comes to leverage buy-to-let landlords when it comes to interest rate rises. So they're not going to sit on their hands. This is real stuff. What surprises me, and which is why I worry that it's more of an industry thing, although brokers at Numis suggest that it isn't, is that how much inertia is there when it comes to mortgage deals? How do customers really sit on bad deals for that long? And how much of the industry's profits does this inertia account for? It's quite a big question. You've got
I think previously, I mean, if there's not a lot of difference, I mean, if it's like if it goes up by like a 1 percentage point or 100 basis point, then maybe people wouldn't be that worried about it. And then the banks would, because we've done that. I mean, with utilities, you sat on a utility deal that's not as good as what's out there, and you think, hang on, if we'd switched like 6 months ago, we'd have saved like a couple of £100 there. But because there's not huge meaning, and it's not the difference between eating or heating or something. But if it is really at the point where everything's, the cost of living is affecting every part of our lives, so any sort of saving you can make, or maybe reduce some kind of cost in some way, or not, then you do it as fast as you can in this day and age. But okay. Next RNS, a bit of a faller. Now it's a man's RNS. I think it's entitled "Drilling Rig Update." Oh, is there anything more sexy than that? Honestly, when you wake up in the morning, see Vox, ping you an RNS, and there you say, "Oh, drilling rig update." Oh, I want to read that. That's piquing my attention. But essentially, Helium One Global it is, and they're Helium Explorer in Tanzania, and they're having a problem, it seems, with Safori, which is this drilling rig, contractor. And they said they've continued to say to them, "Come on, get the drilling rig out there." And it seems like Safori isn't, for some reason. I just imagine they're sitting on their backside with feet on the table, say, "Hang on, plenty of time." But I don't know what's that. So they're saying now they're continuing to review the progress, and they may have to get another contractor in. But what is Safori doing? Why are they not getting on top of this? And they've been contracted to drill. But anyway, even though Helium One is down there, they do say they may be looking at other contractors, and they meet this targeted drilling sort of timeline of Q3 2023. Are you aware of the market for helium?
It's it's a very interesting element.
If you didn't know, I'm throwing you a curveball there. But I did sort of learn about it, then I forgot about it. But I thought it's very interesting where helium's used, and it's literally it's quite scarce, isn't it?
It's scarce. It's scarce. This is the very strange thing about helium. Is that we know it because it's what we put in balloons. But it's a really important industrial.
In medical equipment as well.
Massively important. Massively important industrial chemical that's used in all sorts of applications. And it's short supply. I was reading some time back, there was actually, concerns that we're going to run out of this stuff. And this is really problematic for I say, all these applications that helium is used in. And, here we are sticking it all in balloons.
Well, so I'm thinking, if it's a priority between someone living or dying, or a kid's like 5th birthday party, surely the priority is someone living. You don't need heliums in balloons. They can bounce on the floor. It's fine. And in fact, it's bad for the environment when you let them go anyway. So blow them up with your lungs. That's what you should be doing. Let's prioritize the use of helium, I think, away from 5-year-olds' birthday parties. But that's the chart. It's a quite ugly looking chart there. You can see almost the takeoff here. Look at that, from 5 pence up to sort of 29 pence. And then it's back down to where we are now. And it's, in fact, it did open lower and gapped up a little bit. But that's not a nice looking chart. But,
I feel like I'm looking at the same chart over and over again at the moment, I have to say.
I'm just going to say, can we spot a chart where the trend is on the upside? And it's not.
Few and far between.
Most red RNS is from Vast Resources. They've placed to raise 1.7 million for working capital. And they are looking at this. They've got this parcel of diamonds, historic diamonds in Zimbabwe. They're looking to release. There's a lot of regulatory issues going on with the government and the bank that's holding it. But also they've got a bit of debt to pay. But it's a well-followed company, and they seem to, if they get going, if they get the operations going, could be worth a lot more. But they have stumbled into many issues along the way, and. Obviously, and when you stumble in issues, you obviously need to raise some money. But there we go.
They say it's working capital until the money from this Zimbabwe diamond settlement comes through, and that makes sense. That they were awarded this money, not that long ago, and the shares absolutely rocketed. It does seem sort of that this is just what they need to tide them over until that process is completed. But it is taking a bit of time.
Another horrible looking chart there. So listen, this is I want to do RS today, and let's share this. By the way, this content you can see on the front page of Vox Markets. This is MJ Gleeson, and they've done a trading update. And the reason I want to highlight this is because I particularly myself, I got into these and jumped back out when they broke down on the chart. But of course, we all think now house builders, they've gone through this period where they had an awful time during the financial crash, where they had a lot of debt. And a lot of them now have learned from that. So they've got no debt. Gleason's one of these has no debt. and they are good businesses. We are a nation of home owners or wannabe homeowners. So there's always demand there. We're always underbuilding. There's always lots of demand, there's lack of supply. So house prices tend to go up, over time, and I'm sure we'll revert to that. So these will probably be very good businesses again. And so as for an investment longer term, it's probably a good place. But yet is now the time? Maybe not. So I don't know if you saw this completed. This is for the year. Full year 2023, they did 1,723 homes compared to 2,000 last year. During the second half, 829 homes compared to 1,068. So of course, there's less there. Interesting, the demographic shift. First-time buyers account for 50% of open market reservations. It was 71%, so that's dropped significantly. Whilst 20% of sales are now purchases over 55, so more disposable income. That's doubled. So the over 55 has doubled. Now they do say economic uncertainty causing some larger house builders to hesitate in creating land, because they also sell land as well as build houses. And they say, but the mid-sized and regional house builders remain active buyers of high quality land. Now this is what struck me. Their cash balance has gone down from 33.8 million a year ago to 5.2. Now, they do say they're in line with market expectations. And in fact, I put that on my thing here. So they're going to do about 331 million this year and a post-tax of 26. And it's going to grow next couple of years. But but what's your thoughts? I mean, let's look at the chart on this, because they are, it has come off. It's not as bad as some others. Persimmon, I think, is a bit worse than this. We looked at this yesterday. Yeah. But
it's a good house builder. MJ Gleeson is a really good house builder. It's definitely the pick of the bunch. I would say in the UK. It builds affordable houses. So I think, what was the average selling price? 184,000, which is
186. Yeah, they did say that most couples on a national wage would be able to afford one of their houses. So that's good. Yeah. Good to see.
So this is sort of, I think, if you want to be in house building, you want a recovery play, this is probably where you want to start. The land banking thing is quite interesting. I mean, anecdotally, these sort of mid-sized plots are actually, I mean, I see it around here where I live in Suffolk. They're still getting bought and sold and developed, and they are regional house builders that do it. Not the huge sort of Taylor Wimpey type schemes that you see. So yeah, and actually, you look at the number sold, the number of completions. Compared to some of the forecasts by the larger house builders, this is it's down, but it's not down quite as badly as we've seen at some builders.
Well, Persimmon is literally, it was like 32 quid a share, then they're at low 10 quid, and they are at their lows. And they do carry a little bit of debt. They all pay good dividends, the house builders, though. So, but I mean, that's
because they were massive, very cash generative, historically. And actually, as you've seen, as you pointed out, cash, they're perhaps not as cash generative as they were. If the net cash balance is falling, you've got to imagine a lot more is tied up in working capital, a lot more is tied up in stock. And when I say stock, I mean houses that they're paying to build before they sell them. So it's a tricky sector to invest in at the moment. As I say, I think there'll be value at some point, particularly for things like MJ Gleeson, because they're building what the nation needs, and that is affordable housing. I just think I wouldn't rely on those dividends, because I do think that the cash flow is going to come under pressure in the sector.
Yeah, I don't know if you know. So on the 30th of June, they announced a sale of a portfolio of homes to Carlisle. And this is going to, the consideration for sale is about 50.4 million. So that's going to help them a little bit there. And I just think, maybe not now, but if you look at the chart there, they have rolled over. There was that almost, because for a while, wasn't there was a talk of this may be the last interest rate hike the Bank of England is going to do, and now that was the last one we just had, and now it's seemingly, we're going to talk about that in a bit, but it's seemingly going to be a bit more coming down the line, and that will hurt the housing market even more. So we had this rally here. They had this rally here where we thought, this is the last interest rate hike, and then all of a sudden everything got bearish again, and they said this is a 200-day moving average, come back down, and now it's a retest to that the March sort of or January lows, or a little bit. In fact, there's a little bit higher low there. Will that hold though? I'd be telling to see if it goes below that. I put an alert on that level. But
that Carlisle news is quite interesting actually. That's an American company, American investor.
Are they?
Yeah, so you can't imagine that they're buying them to flip them. I mean, that would seem a strange Saturday. Are they buying them as a sort of buy to rent? type
I
portfolio.
say global investment firm, yeah, Nasdaq. So I
Yeah,
didn't know.
yeah,
Gave
yeah.
us an investment, market leading single family housing investment manager.
It's quite interesting. So you know, build to rent is something that's been sort of taken off in recent
Yes.
years. You know, so most of the time, the housing market in the UK in particular is worked by you know, a house builder builds a house and it sells a house. And increasingly, you know, investment firms want to own houses that they can rent for the income that produces. And if they're doing it at scale, then you know, they can actually manage these portfolios much more efficiently. You know, finance them much more efficiently. So yeah, it's actually quite interesting, this.
Yeah, because
you know,
rent isn't coming down, is it? Let's be honest.
no,
I mean, you know,
rents are going up. So that
yeah.
you know, I've not seen a deal like this really before, and I think this is quite interesting. Something to keep an eye on across the sector. We might see more of this. See more of this.
I just want to show you I'm a bit obsessed with the inverted yield curve for people who haven't bored this with. It's worth looking at this. If I go to bonds here, in fact, and look at this inversion of the yield curve. Now, literally that red line there, that dotted line is 0. So that's when it inverts. You know, the 2-year, the yield you offer on a longer duration bond should be higher than a shorter duration bond. That isn't happening. That means a 2-year bond yield is higher than the 30-year or 10-year. When that happens, it doesn't happen very often, but the last 10 times that's happened, there's been a recession. Now, it could be some manipulation in the, you know, because central banks basically own the shorter duration. They've raised interest rates a lot, so obviously that's happened. But if you look at that, it did sort of bounce off that all-time low recently of this. It went down to more than 1%, minus 1%, bounced off that. But if we put this on a weekly chart, you can see why this is quite telling, because the red lines here are recessions, okay? And whenever it's gone below that minus 0.2, there's been a recession every time. Look at it now. This is down at 1. It's never been this low, ever, inverted. Maybe it's a reflection of they've never increased interest rates this fast since 1988. I don't know if they have, but that's quite a worry. But having said that, the markets tend to rally after an official recession is announced. So as soon as you get that official stamp, it's a recession, that's maybe good for the markets. But like I said, it just shows you there. It even sort of inverted briefly. By the way, there's about 18 months, a year to an 18-month lag between this inverting and the recession announcement. But even before the COVID pandemic, which is very odd because no one saw that coming. It came out of the blue from China, who knows where in China. But and then it inverted. It sort of predicted that recession. So really odd. But anyway, this. But yeah, that's a chart I want to show you. An interesting chart. So let's talk about some macro. 3 news from the macro. So
yeah,
this is a big one. We talk about house prices a lot, but they've fallen for the 3rd month in a row, according to Halifax, as mortgage rates for millions continue to rise, down by 0.1%. But the interesting stat here is the banks say house prices have fallen by 2.6% compared to a year earlier. That's the biggest annual fall for 12 years. That's quite a big number, isn't it? It's a long time since it's done that,
Yeah,
that's significant.
Yeah, and the markets, I mean, the housing market is very soft. It's very soft. And we've talked about it, this week. There are things that are in the market's favor, shortage of supply, but there are so many headwinds. The fears of a recession, fears of affordability, generally stretched affordability, rising mortgage rates. This is a perfect storm for the housing market at the moment.
I saw someone on Twitter said to me they've started to average into Taylor Wimpey, or I think Persimmon, or one of the two. I think it was Taylor Wimpey, and he said, "To me, it's a no-brainer." Now, I hate to say I don't think I hate that phrase. Any investment is a no-brainer. I don't believe any investment is a no-brainer. You have to put a bit of brain work into it. In fact, to get to the point where you realise that was a good investment, you use a bit of brain work. So there's very little. There's no-brainer as an investment. But what do you say from here? If you're scaling in over years, maybe one of the house builders is a good investment, maybe, because we are at now maximum bear, and everything's really bearish on the house builders. I mean, and also that provides opportunity, because whenever, I mean, you can't wait until it starts getting rosy again, because the markets were rallied by then. So you've got to buy when there's fear and blood in the streets, and the house builders are in the center of that, the epicenter of that worry, that sentiment. So if you're averaging slowly, picking up the dividend, is it a good time to start?
I'm not sure the blood is on the streets yet, Justin. This is the thing.
Okay. That's it. Yeah.
So the market is efficient. So we can assume that the Taylor Wimpey share price is based on the collective views, sentiment, data that from thousands and thousands of market participants. So how is the data wrong? at the
No,
moment.
but the market isn't efficient. That's why people make money because the market is literally driven by investors. Investors are
Yeah.
largely emotional. Obviously, we have big more algorithms involved, but we all know everything overbuys, oversells. We've shown numerous charts where companies have IPO'd and they've all got shot up there because everyone believes the market's going higher when there's a bull market. Everyone believes the market's going lower when there's a bear market. So surely pessimism is your ultimate friend in the sentiment. When we know everything is oversold. We know that happens. And then in between that overbought and oversold, there's probably that's the market where the market's efficient and it's fair value. But above that, there's advantages. Maybe you go short, maybe you go long. So who knows? You can't really wait until things start turning rosy, can you?
I've never liked that expression oversold because it's only the selling pressure that tells you what something's worth today. Something is only worth what someone is prepared to pay for it, and that's what they're prepared to pay today for a share in Taylor Wimpey. And I do think that generally I say the blood is not on the streets for this sector yet. They're still last year delivering massive profits. They're still paying those dividends. Watch what happens if one of them cuts the divvy. Watch what happens. Then it gets really messy, and then the blood is the blood is on the streets. I do understand the scaling in argument. Over the long term, the weighing machine of the market. We will get there. But yeah, I don't think the pain is over for housing. Definitely not.
Okay. One more is related to that, but a severe money market shift signals worse to come for personal and public finances. They're now saying money markets are beginning to price in the Bank of England interest rate going to 6.5%. Again, we've seen this kind of worry before. It never plays out. But where are we at the moment on interest rates? Are we 5.5, 5.25?
Yeah, something like that. I've heard talk of 7. I've heard talk of 7 on the way. There are. This is out of control. And the Bank of England seems intent to stay firm, to stay its course on its mission to fight inflation. Maybe with some pressure from the government involved, even though the Bank of England is independent, because obviously that's one of Rishi Sunak's 5 key pledges to halve inflation. But yeah, it's very, very tough. And as we saw in OSB, rates get to this high. And it changes people's behavior. It will change shoppers' behavior. It's changing landlords' behavior as they refinance, the speed at which they refinance. This is what it's intended to do, by the way, change people's behavior.
Yeah, but I don't think they're seeing the crack. They can't see the cracks that are not appearing. Like you see, you get these offshoots, these odd, consequences that happen. Like we just, one savings bank. That's what happens, which they don't predict. And there's certain things that break, and they're not predicting. And I think there's, which is the start here. Like I said, we've only been at this high interest rate for the last, 3-4 months. You wait until we're up here for 6 months. There'll be a lot of businesses suffering and collapsing and falling. A lot of people being laid off. You can't re-employ those people. You can't restart those businesses. Once it's gone, it's gone. So I think now sometimes they should pause and say, let's see the effects here. Because we know inflation is coming down. All commodity prices are coming down. We've seen that. That'll play in. The PPI index is coming down, contracted by 1.5 last month. So things are moving in the right direction for inflation. What's wrong with the pause here? Why keep ramping it up, not knowing what you're going to break? That's my thought. I think you can go too far. And,
certainly in the US, I mean, the Fed has paused for exactly that reason, to assess the data, but a hawkish pause, it sort of leaves the door open for more rises in future. But no, I think you're right. I mean, it does risk doing damage, but on the other side of the equation, you've had, however many years since 2008, very, very low interest rates, ultra low interest rates, and that's led many companies, not all companies, but a lot of companies to, borrow beyond their means, to invest in ways that were perhaps unproductive. Because capital was so cheap, and actually, what perhaps we're seeing now is a return to reality rather than the last 10 years or of zero interest rate policies being the reality. This is normal. This is perhaps what we need to adjust to. And companies that cannot survive rates of 6.5% are probably not very good companies.
Yeah. No, but to be honest, it's true. They say at the moment, most people who happen to refinance their mortgages have been stress tested at higher levels than this on the interest rate. But you often wonder, did they lie on the form though? When they were, yeah, we could pay that. But have they got the same job? And were they straight on the form? But because let's be honest, when we were back at like 0.5% and you're getting mortgages for 1% or whatever, no one ever thought it'd get to 5% within a year or so, or 2 years. So
but I mean, you look at those low rates, and we've talked about house price affordability. Those two things are not unconnected. Cheap money equals higher asset prices, and property is part of that. I spoke to a very interesting property investor the other day at a company called Custodian REIT, and actually he says, this environment is good because it shakes out the smaller players who've invested badly, and actually what people were starting to know is that what stuff is really worth. So at 6.5%, you actually start to know what something's worth. Whereas
nothing. In certain business cases.
Whereas when you can borrow and buy and borrow and buy, and don't really have to worry about the cost. There's no price discovery.
Yeah, exactly. When you can just get free money, exactly, just take the money and just do silly stuff with it. Like, for example, I mean, the height, I keep saying there's a height of the market top was when people were paying millions of pounds for gorilla NFTs, those chimp NFTs.
No, Justin Bieber.
Yeah. Why is that a good investment in any person's world? It's not. It's like you realize that's the froth, the top of the market. And in hindsight, it's obvious right now because you realize now money costs something, they're worth nothing. Those things.
Yeah, exactly.
Anyway, let's finish off on a slight positive. I was going to cover the third story of Twitter whinging about Threads saying we're going to take you to court. Threads for copying our thing, but it's an open source one. I don't see what. Again, you have to protect what you have.
This is standard Silicon Valley, isn't it? I mean, it's standard Silicon Valley. They're always, suing each other, left, right, and centre. I'm sure mobile phone operating systems. This has been a constant source of legal battles between Apple and Samsung and Google, and it's just the way that this industry works.
Yeah, there's only one. Exactly. I mean, it is. Nonsense. I don't see how they get anything done. That's why there's so many solicitors and lawyers in America, because that's all they do is go to court. Let's just finish off with the indices. There's only one green there. That's the FTSE 250. Surprisingly, the biggest fall there is OSB. Futures second. I'm one of the. Futures one of those companies I want to get in. I don't know when the trend's going to end though. But that's the FTSE 250. It's had a good rise, isn't it? Listen to that, from 1999, pretty much. It's gone from like 4,000 to almost 24,000. And now it's rolling over a bit, so you'd expect a bit of bit of sell-off.
It's a generally upward trajectory, and there you go. There is the lesson of the day that this is not a daily game; it's a long-term game.
Yeah, marvelous. And don't forget, if you see any, no one's watching RNS o'clocks coming out, let us know about it, because there was one last week. Horrific. I'm not going to say the company. Horrific losses, but you can't do that in this day and age. Vox Markets, for example, we've got an app that notifies you when you get, an RNS from a company you follow. Now, years ago, when that didn't happen, you could probably get away with a late RNS on a Friday afternoon when markets are shut, but not now. It doesn't work, PR company people. It doesn't work. You can't sneak out an RNS late in the evening, hoping no one will read it, because we will, because we're notified by it via the Vox Markets app.
Really?
By all means,
I won't be reading it today because I'm going to the pub. So.
All right, that's the best place. That's it. Well, in my mind, you're bolstering the leisure sector that needs
exactly,
that,
exactly, giving it a boost.
Well, have a